So basically, last meeting we learned about stocks, right? So stocks are like pieces of companies or like shares of companies. So by owning stocks, you own a part of the company, like including the profits or losses of the company. By the way, can you guys hear me?
Yes.
Yeah.
Okay. Wait, yeah, okay. So, well, I was gonna play a game, but anyways, so basically, let's play a game. So I'll show you a stock symbol or ticker, and like you tell me the company's full name. Because each company, like if they have a stock, then they have a ticker that represents the name. So like for example, when I show you GOOG, then that company is called Google, so you can just blurt it out. Yeah, Damien.
I know one.
Okay, I'll tell you later. Basically, does anybody know what AAPL is?
Apple.
Apple.
How about, I'm gonna start with some simpler ones, okay? PSLA.
Tesla.
Great. Does anybody know what KO is? And it's okay, you can search it up if you really.
Coca-Cola.
Did you search that up, Chloe?
Coca-Cola.
Yeah. How about PEP?
PepsiCo.
Pepsi.
Pepsi.
MA, this one you might not know if you don't search it up.
MasterCard.
Do you know what a MasterCard is?
Yeah, it's a type of credit card.
Yeah. Okay. CVX.
Chevron.
Okay, how about this? This should be a kind of famous company. DIS.
Disney.
Disney.
MSFT.
Microsoft.
Cost. I'm just gonna say cost.
Costco.
TGT.
Target.
UMP.
Walmart.
Amazon.
How about CVS?
CVS.
CVS, not CVX. CVS. That's a pharmacy, like the CVS pharmacy. Like sometimes when you're driving, you can like not you driving, when you're like in a car or you're walking, you sometimes see those pharmacies like brick and they say CVS. How about this? JPM.
JP Morgan.
That was quick. How about MCD?
McDonald's.
KR.
Kroger.
Kroger.
How about V? Like just V.
Visa.
Yeah, let's get V.
Visa.
Verbal.
But yeah, I think it stands for Visa. NKED.
Nike.
Yeah, Nike. HD.
Home Depot.
BA. To be honest, I have no idea.
Boeing.
Boeing.
Yeah. Oh yeah, Boeing, the chain company. How about SBUX?
Starbucks.
That's like S-Bucks, like when you pronounce it. Anyways, so let's move on to the discussion questions. So in the book, like here are the discussion questions of chapter 6. I don't think we'll have time to talk about the discussion questions of chapter 7, but anyways. So, in the book, it talks about these 3 legendary investors. One includes Warren Buffett, I think. Anyways, the book talks about 3 legendary investors. So why could the 3 legendary investors beat the market? Right, here's the book. Chloe?
The 3 legendary investors have beaten the markets because like the really good investors, like for example Warren Buffett, like for example Sweden, he achieves the outside returns because of top-notch professional resources, and like they have like very good venture capital and good funds.
Yeah.
Yeah, and they study a lot for the investments.
Yeah, excellent. So does anybody else have like a slightly different idea? It's okay. There's no extremely correct answer. Okay, yeah. So about that, yeah, the three legendary investors, because like the book said that a lot of investors couldn't beat the market, right? But the legendary investors, they could beat the market because they had a lot of good resources, like investments normal people don't have. Also, they have a lot of time studying the investments because their job is basically being an investor. So they spend every waking hour studying the investments, and they have a lot of they have access to a lot of prime information and deals. So the second question is, what is the difference between active funds and index funds? And since the book covered this a lot, you should know what an active fund and an index fund is. Question number 2. Oh, and Chloe, is it okay if I'm calling you this time?
Sure, I'm fine. I'm just like, I know the answer.
Does anybody know the answer besides Chloe? Okay, fine. Then I'll call on someone. What's at the bottom of this? Isabella? What's the difference between active funds and index funds? Can you guys hear me? Am I muted? I'm not muted. Okay. Well, the difference between active funds and index funds is that like active funds are managed by portfolio managers who like real life portfolio managers who like actively try to pick the best stocks. But like they usually fail to beat the market because the humans and they like can make mistakes like selling too quickly, trading too much, and like making bad guesses or something. In contrast, index funds are basically computer generated. So they work by replacing portfolio managers with computers. And these computers like don't need to find the trendiest stock. They just pick the stocks that like are included in some indexes they track, like the S&P 500 index or the Dow Jones Industrial Average. And then so they can try to match the market. So a big difference between index funds and active funds is that active funds, they have higher fees than index funds, because index funds, they don't take a lot of money to maintain because they're just a computer. But with active funds, like just real life people, and they need to be paid a comparatively high salary. So yeah. So question number 3. In the chapter, the author said that the fund managers fail to beat the market 75% of the time. And like not a lot of people needs fund managers. So if nobody needs fund managers, why are there so many fund managers available? You'd think they would have gone out of business, right? Livia?
Because some people still think that fund managers will help them, their investments, or because they're too lazy to do it by themselves, so they want someone to do it for them, without realizing that there could be a downside of that.
Yeah, exactly. Excellent. But wait, who's Jia Liu? Do you have a question?
Oh yeah, sorry. It's not a question. It's just like something to answer the question. Um, so I think like the reason that there's so many fund managers is because like people don't really like some people don't really understand like the like why there's like well the thing is fund managers don't really help you too much because like they can make mistakes and they can't always like predict the right thing. So like so it's kind of and then it's also pretty convincing. Like fund managers like make their uh like reviews kind of good, I think. And then like so like a lot of people are convinced that they're gonna be good and like try to like help them have higher I guess.
Yeah, great. So does anybody else have a different answer, or is it like basically the same? Chloe?
So like they basically kind of trick them. Yeah, they basically scam for their money. Even if they also earn money, they just like earn money, like for example, like beat the market like by I don't know, like 60%. The next year they might lose, so it's really unpredictable. And then there's a lot of tax fees and stuff like that.
Yeah, great. So basically the author has some biases because he thinks that the high fees and poor returns of the funds, like for the fund managers, are big drawbacks, like major drawbacks, and they are. But like a lot of rich people don't chase high returns on their investments, but like they prefer safety. Because let's say you're a rich person and you have $100 million invested in the stock market, okay? So you wouldn't care, you might not care that much. Well, a lot of rich people don't care that much. Like if the fund managers like overall only earn them 1% a year, because they would have like they would earn $1 million a year, right? But they prefer to like have safety. They want to make sure their investments won't lose the money. Since they already have so much money, they don't need to worry about making more money. They just need to know they aren't gonna lose most of the money. Like in other words, they're okay if the investments have returns less than the returns of index funds, as long as their investments have fewer risks than the index funds. So like here's a chart and a table of the all seasons portfolio managed by Bridgewater to the most famous index fund SPY. So the blue line here is Ray Dalio's all seasons portfolio, and the red line is SPY. And you can see, and I'll just give you guys a moment to study it, okay? There's a table down here. Okay, so basically, as you can see here, Ray Dalio's all seasons portfolio earns less than SPY, right? The best year of Ray Dalio's all seasons portfolio is only 18%, while SPY's is like 32%. But the worst year is like Ray Dalio's all seasons portfolio's worst year is only negative 19%. While SPY's is negative 36.81%. And the max drawdown is like less than half of SPY's max drawdown. And so yeah. So overall just like less risk, right? Now let's do a case study. On page 194, the author wrote, companies like Morningstar offer ratings of funds that are supposedly. But wait, are you guys following me? Like,
Yeah.
Okay, Chloe, do you have a copy? Oh, okay. So basically, on page 194, the author wrote that companies like Morningstar offer ratings of funds that are supposedly like simple reflections of their value. But the idea of Morningstar's 5-star ratings is actually complete nonsense. Because receiving 5 golden stars doesn't actually predict success, and that like assigning 5 shiny stars to a fund doesn't mean it will perform well in the future. So here's the latest kind of shocking example, okay? So Silicon Valley Bank, which is a bank, was shut down on March 10, 2023. Basically, the bank was bankrupt. So after this event, its price dropped from $267 to 45 cents, which is like negative 99.8% price decrease. So the stock price was like almost zero. Investors lost all their money in the stocks. However, just a few days before the bank failure, by the way, this is the stock, some institutions gave the bank ratings like overweight, buy, etc., which means that people should buy the stock. If you'd actually listen to those institutions like Wells Fargo and Goldman Sachs, you'd like invested like $1,000 or $10,000 in Silicon Valley Bank, you would have only ended up with, let's say, $10, okay? So you can see here, Wells Fargo and Company, just one day before the bank collapse on March 9, told you to buy the company. So basically, the main question for this case study is that what did you learn from this? And so like, what lesson did you learn from this? Chloe?
Like from the SVB, I learned to not trust ratings. Like for example, if they give like a grade A, doesn't mean it's gonna grow. It might like lose. So you should like don't trust. You should actually like look in their fundamentals and technicals and and look over like the company, not the ratings.
Yeah, exactly. So Aurora?
I think perhaps, well, personally, I learned that, like what Chloe said, to not trust the ratings that some companies give, but rather look into the future more and like figure things out and see if the company's going to do well in the future.
Yeah, great. Aurora. So Isabella?
So I learned that 5 stars doesn't actually predict success, and also it's really, really difficult to predict which stock will be like will earn you money.
Excellent. So by the way, Livia, do you have like a different answer or something?
So I learned that before you buy stocks, you should probably look to see how good it is done and look, so if it's technology, you should probably look at the technology advances. Like just look back to see how good it has done so far. Like it might be a lot of money where at one point, but you have, like if it's a bank like Silicon Valley, then you have to look at how good it does. Like just because it has 5 shiny awesome stars does not mean that it might be that good in the stock market or that it has enough money.
Yeah, exactly. Great. So William Song. William.
Okay,
Yeah.
so I want to say something about this. Okay, so it also depends on who's giving the rating. Like if it's like a biased rating, like biased towards the company, like you definitely shouldn't trust the rating. But like if it's like a consumer's rating and like they're continuing the rating for like a pretty long time, I think it's okay. But it depends.
That's actually a really good point, William. So like, yeah, if it's like the same company, you shouldn't really like believe in it. So the 2 points that I personally like, you might have different takeaways from this, but the 2 points that I personally think like I personally learned from this is that number one, yeah, you shouldn't really trust those institutions that much sometimes, because those people will make mistakes too, like buying when you shouldn't buy or selling when you shouldn't sell. Mm, um the second takeaway I got from this was that you shouldn't put all your eggs in one basket. Basically, you shouldn't invest all like 50% or even 30% of your money. Like, you shouldn't invest a lot of your money in one single stock. Like, if you'd invested $5,000, like if you'd invested 30% of your money in Silicon Valley Bank and you'd listened to those institutions, you would have lost basically all of your money. That would have been like a huge bummer. So here's a lab activity. On page 192, the book wrote that Putnam Investments studied the performance of the S&P 500 over 15 years, like during which time, like the average annual return was 7.7%. So they noted something amazing. During that 15-year period, if you missed the 10 best days of investing, your return would have dropped 7.7% from 7.7% to 3%. And if you missed the 30 best days, your returns would have dropped to negative 2.5%. Negative returns. And the scary thing is, those best days were the days where the stock market has just plummeted a lot. Like you can see here, like the stock price was about, let's say 300, I think, yeah, when it dropped to about 200. So like you would have lost a lot of your money, and many people panicked at that time because it was scary, kind of. You might think, wow, you shouldn't sell all your stocks. You just should have like waited until the stock prices went up again. But many people panicked because yeah, they lost a lot of their money there. And so you can see here. So now let's do some computer experiments. So here's wait, hold on, actually no. Okay. Basically, God. Yeah. Yeah. So here you can see like the start date. How do I pull this up? You can see that the start date is like January 1, 2000 to January 1, 2023. So let's run this. Gosh, this thing is blocking me. I know. Okay, and here's a graph. So basically this is like the graph of the S&P 500 or SPY. That's the SPY. And like during those days, okay? And here are the best days for trading. You can see they're just after the stock market plummets. You can see that total trading days is 5,787 days, right? If you were always holding the index fund, then that would be, you would have gotten 300% increase. But like if you missed the best 20 days, you would only have a 7.5% profit. So if you were always holding the index fund, the stock would have tripled in value. But if you'd missed the best 20 days after the stock market plummeted, your profits would only be 7%. That's like a big gap. So now we can enter in like different values. Let's see, how about 2010? So you can see here that this is of a span of 2,515 days. Of course, the stock market was kind of bad that time because there was a 2008 bear market. But you can see here, if you were always holding the index fund, you would have a negative profit of 8.7%. Okay, that's bad. But if you missed the best 20 days of trading, your profits would have been negative 70%. Basically, does anybody else want to try some dates like you think would be like, does anybody else want to try some dates for like to see how much you would have earned if you were always holding the index fund or if you'd missed the 20 best days? Chloe?
Wait, can I try 1925 through 2023?
19, wait, what?
1925.
I'm not sure they have that data. I don't think they have that data.
Okay, I'll try 1995.
Okay, I'm still doubtful they have the data, but I guess we could try.
To 2023.
Hey, they actually have that data? Hold on. Is this from 1995? Then why does it say 7,050?
Can you we can try 2000 through 2012.
Let's just see this data point. Basically, yeah, that should be from 1995. So maybe they have that data. So you can see here, if you were always holding the index fund, that would be 1,282%. Well, that's a lot. And if you miss the best 20 days, yeah, sure, you would still have a 260% increase, like profit. But you can see that's still a really big gap, right? And that's only 20 days out of those, out of that much years. Out of that many years. If you missed just 20 days, then your profit would have gone down from 1,200% to 260%. So does anybody else have any other dates they want to try?
Can we do 1995 to 2010?
Okay. Want to choose a month? Because this is January 1st.
May.
Okay. Okay, let's see. So that would be 3,778 days, as you can see from this graph. Oh, can you see this graph? Anyways,
Yes.
if you were always holding the index fund, that would be 198%. But if you'd missed the best 20 days, your return would have been a negative 11%. From positive to negative. Out of 15 years. So does anybody else have other dates they want to try, or are we good?
1990 to 2012.
Okay. Was that when you were born?
What?
'Cause I was born in 2012. Anyways.
Good for you.
Okay, here's a chart. So if you were always holding the index fund, you can see here that would be 350%. But if you missed the best 20 days, then that would be 35%. That's that's a 10%. It's only 1 out of 10 of the profits you would have if you were always holding the index fund.
I got a date.
Yeah.
2015 to 2023.
Mm. Where's the graph? So if you are always holding the index fund, that would be 128%. But if you'd missed the best 20 days, that would be negative 7%, as you can see from this graph. Guys, see this? So yeah, I told you, that's like big difference in those crucial 20 days.
I got another one. 2016 to 2019.
Okay, this should be the last one, okay? Wait, 2016 to 2000 what?
19.
So that's from 48.8% to negative 1%, which is like essentially the same as zero. Exactly. So yeah, these big boxes are the days where like the best days, and yeah. You guys see that? Okay. So are you guys following me now?
Yes.
Yeah.
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 So I'm just gonna now let's move on. So yeah, as I said, this was like really surprising. If you missed those best 20 days, your returns would have dropped a lot. As you can see here. So yeah, this is last meeting slides again. So I don't know if some of you saw this or not before, but stocks are basically pieces or shares of companies, and like by owning stocks, you basically own the like the fortunes of the company. And like some company stocks have two classes and for shareholders' rights, all that stuff. Basically, now we're going to look at market indexes. Basically, a market index tracks the performance of a specific basket or selection of stocks that represent a particular market or economic sector. So like there's examples including the Dow Jones Industrial Average and the Standard & Poor's 500 Index, NASDAQ Composite Index, and so on. So you can't directly invest in these indexes, but you can invest in like these ETFs and mutual funds that track the indexes. So the Dow Jones Industrial Average, DJIA. So basically, the Dow Jones Industrial Average is a stock market index that tracks like these 30 large cap, like these large publicly owned blue chip companies, like on the New York Stock Exchange, NASDAQ. So this index is like considered to be a gauge of like a general gauge of the broader US economy. So it is a really famous and widely watched index for like US blue chip stocks. By the way, blue chip stocks are like nationally or internationally recognized and mature, financially sound companies. So blue chip like companies generally sell like really high quality, widely accepted products, basically. So the Dow Jones Industrial Average has 30 components. Like those components change as the economy changes. So a component may be dropped when the company becomes less relevant to current trends of the economy, and they'll be replaced by a new one. So for example, a company may be removed from the index when its market capitalization drops because of financial distress. So the index value can be viewed as a simple average of all the 30 stocks share prices. Like basically higher stocks with higher share prices have greater weight in the index. So you see Apple Inc., right? I have a question. Do you know when it was added to the index, like according to this graph below?
2015.
2015.
Right here, right? So do you think adding Apple in the index reflects trends of the economy at the time?
I think it helps.
Well, yeah, me too. Cause like, around 2015, Apple was becoming increasingly popular and stuff. There were new iPads and iPhones and smartphones and all that. So it signalizes like a new age, basically. So now let's move on from the Dow Jones Industrial Average to the S&P 500 index. So the S&P 500 index features 500 leading US publicly traded companies. These companies can be categorized into like 11 sectors, such as you can see here: technology, healthcare, healthcare, energy, communications, semiconductors, financial, industrials, all that stuff. So it is widely considered one of the best gauges of stocks of like those large US companies and the market. So same as the Dow Jones Industrial Average, the S&P 500 index has like very strict criteria to include companies of good quality in the index and to drop companies not meeting the criterion. So like this index is like market capitalization weighted. So that means the larger a company's market capitalization is, the more weight it has in the index. You might recognize some stocks like Microsoft, Apple, Google, Amazon. But basically, you see these large squares and indexes, right? The larger, larger squares and rectangles, right, in the index. The larger a rectangle, like the more weight it stands for in this graph. In this graph here. So like you see Apple, it has more weight in the S&P 500, like just like it occupies a greater percentage of the index than, for example, let's see, Verizon, my mom's company basically, or Costco, because like the rectangle is bigger. So like here, just like for a bit of background knowledge, the red rectangle signalizes that a company has a loss, and the green rectangles, like the greener it is, the better, signal profits. As you can see here, I just give you a few seconds. Okay. Now let's talk about the NASDAQ Composite Index. So the NASDAQ Composite Index is a market capitalization weighted index of more than 3,700 stocks on the NASDAQ Stock Exchange. So it is like a broad index, but it's like heavily weighted towards the technology sector. So there's more like technology stocks like in the index. So the NASDAQ 100 index is a basket of the 100 largest, most popular or like actively traded US companies on the NASDAQ stock exchange. So basically, it is also market capitalization weighted. So the index includes a lot of companies from various fields such as retail, biotechnology, industrial, healthcare, and others. But it doesn't have the finance industry stocks. The S&P Mid Cap 400 Index is a market capitalization weighted index of 400 US companies with like mid cap US companies, like they're in the middle, like they're big, but they're not as big as some other companies, like say Apple or Google. So the Russell 2000 index is another market capitalization weighted index of 2000 small cap companies. So it is frequently used as a benchmark for measuring the performance of like these small cap funds. So it's an important market index combined with the S&P 500 to check the safety of like the market, like if there's a bear market or if there's like a bull market. A bear market, by the way, is a market that's going down, but a bull market is a market that's continuously going up. Now, do you guys know what an ETF is? An exchange traded fund? Like, if you know, just raise your hand. Okay. Basically, an ETF can be viewed as a basket of several stocks, or like a selection of several stocks. So typically, the ETFs will track a particular market, or like an index. So ETF share prices fluctuate all day like regular stocks, and like ETF shares can be bought or sold all days like stocks, like which is different from mutual funds, which only trade once a day. Compared to mutual funds, ETFs generally have very low fees. And the first ETF was the Spider S&P 500 ETF, SPY, like a really famous ETF, which tracks the S&P 500 index and is an actively traded ETF today, very popular. By the way, are you guys following me?
Yes.
Okay.
Yeah.
So, like this ETF tracks the Dow Jones Industrial Average, DIA, the Spider Dow Jones Industrial Average ETF Trust. You can see here. Yeah, like this is the ETF trust and this is the Dow Jones Industrial Average. So now let's do a lab activity. In Google search, basically in Google, input DIA holdings and see what's in the top 10 holdings of this ETF. So now you can go on Google right now and just like type DIA capitalized holdings. I might do that too. But you know what, never mind. Have you guys gotten like the top 10 holdings yet?
Yeah.
Does anyone else besides Chloe, like has anyone else besides Chloe gotten the holdings? And yeah, you did a good job, Chloe, okay? Good job.
Yeah.
I got it.
Okay, I'll just wait a few more seconds and then
I also found it.
okay, great job. Okay. So here are the top 10 holdings of this ETF that you might have gotten. There's United Health Group, Inc., Goldman Sachs Group. This is a big thing. Microsoft, Home Depot. Oh, never mind. Home Depot, yeah. McDonald's, Amgen, Visa, Caterpillar, Boeing, Honeywell International. Oh, that's it. And you can see they're arranged in the order of like which company occupies the most in DIA, the ETF. So here are some ETFs that track the S&P 500 index. So the Spider S&P 500 ETF Trust, which is basically SPY. This iShares Core S&P 500 ETF, which is like ticker symbol IVV, Vanguard 500 Index Fund, ticker symbol VOO. And here are just some pictures of the stocks. Okay. So here's a table of like those main indexes and the ETFs. So you can see Dow Jones Industrial Average has DIA for an ETF. SPY S&P 500 Index has a lot of ETFs. There's 4. SPY, IVV, VOO, SPLG. By the way, we'll do something involving SPLG later. NASDAQ Composite Index has ONEC. NASDAQ 100 Index has QQQ and QQQM. S&P 500, S&P Mid Cap 400 Index has MDY, and Russell 2000 Index has IWM. I'll just give you a moment to look at this table, and like feel free to like search up these ETFs if you want later. So now let's do a lab activity. You guys should have like a Fidelity investment account that you set up before this class. So following these instructions, log in to fidelity.com. Just go to Google and enter your account and click the trade tab as shown below. Have you guys like gotten to fidelity.com?
Yes.
What if you have Charles Schwab?
Yes.
Charles Schwab? What?
Schwab? Like if you use that one, if you use that account.
Have you guys now when you log into the fidelity.com website, click the trade tab as shown below. Have you guys I clicked the trade tab and you should like
Yes.
so you open up to like an open trade window, input the following information. So you have this trade window, right? It should appear here. Does anybody not have the trade window open up? No, okay. So in this symbol place, input SPLG, like the ETF that tracks the S&P 500. So in this like symbol place. And then everybody got that. And so basically in action, select buy and quantity like over here, input 1, and order type, select market, and time and force, just select day and open. So basically, once you're done with inputting the following information, your trade window should look like this over here. So if you're done, tell me, okay? And yeah.
Wait, my screen looks a little bit different from yours.
I think you need to click the view enlarged or expanded ticket.
Just like this blue link saying view simplified ticket. If you're in expanded, yeah,
Oh, okay, thanks.
and you should open up. So I'll give you guys a moment to like select these, and once you're done, don't just wait for me, okay?
So for when it says time in force, it says stay. Do we change it to on the open?
Okay, you can, I guess. Okay, now, so basically, you see this blue button here, dark blue, it says previous order, right? So click on preview order, and then here to give you a long list of stuff, you can just skim over, and I can see if you, like, just check if you bought the right thing. Well, actually, to be honest, you can buy SPLG if you want. Buy SPLG, you can buy some other stock we talked about, like SPY or DIA or anything. But here I'm just gonna yeah, this is an example. So I'm just gonna buy SPLG, okay? Just click preview order and check that you got what you needed. If you're not, you can just click cancel or like exit or whatever. And if not, just click the buy button, I think. Or whatever it's called. The buy button, yeah. So this has everybody gotten like bought your stocks and gotten to these steps? Hello?
Yes.